Hey everyone, welcome back to another episode of my Magic Formula Portfolio series, where I'm running an experimental Magic Formula portfolio as made famous by Joel Greenblatt in his book, The Little Book That Beats the Market. So I'm attempting to build my own Magic Formula portfolio to see how it performs in today's environment and beyond into the future, since this is a real-time experiment. We've seen the back test, as the book has explained. It did very well in the period where it looked at something like 1990 up until the early 2000s, then later extended that into the 2010s. So and the results there looked really, really good, but there's been some debate around this sort of strategy, whether it's actually viable nowadays, whether maybe the cat's out of the bag. Everyone knows about the Magic Formula portfolio now, so if you wanted to do it, you can go ahead and use magicformulainvesting.com to build your own portfolio right away. So if everyone can do that, and it's so obviously better, then that would sort of eliminate the extra edge that you'd have by doing this portfolio, one would think. But who knows? I don't think it's that widely adopted to the point of being completely ineffective, but time will tell, that's for sure. And that's part of the reason I'm doing this portfolio series, to kind of see what's going on here. Getting a few months, a few years of data eventually to see what's going on, whether we can learn something from it. Maybe there are some good ideas within the Magic Formula portfolio that you could add to your portfolio if you so desire. None of this is financial advice by any means. Again, this is more of an experiment. But I thought, let's go ahead and get into the actual changes I made this month to the portfolio. Not really changes I made, but changes that the screener made. I go over to magicformulainvesting.com. That's this site right here. It's free to open an account, and it allows you to screen the top stocks based on the Magic Formula investing strategy factors, which are return on invested capital, or ROIC, and also earnings yield, which looks to see the relative cheapness of the company based on its actual earnings. Whereas return on invested capital is more of a quality metric. That's the idea it's going for. It's a proxy for quality and a proxy for cheapness. So if we rank every single stock in the stock market, at least the US stock market, if we rank them all based on market cap, or minimum market cap, that is, so everything above market cap right here is $50 million. That's what's recommended in the book. It would take all stocks over that market cap and then look at, based on those two factors, the ones with the highest return on invested capital and the highest earnings yield, to see which are the cheapest, best stocks relative to the rest of the market based on those two metrics. You could certainly make plenty of different qualitative and quantitative arguments against it, but you can see this is what happens when we do the top 30 based on those market cap characteristics, and this is the list we got, which if we go over to the tracker spreadsheet that I always have in the description below, then we can see what was changed versus added to last month. And there was quite a bit of churn. I think that's because we had a good amount of earnings come out, which changes some of the numbers on the back end with return on invested capital in particular. And if you get big price movements, that will change as well. And we had a, I guess, relatively volatile market in the last month or so, but I mean, you could say that about lots of individual stocks. Many different stocks are more volatile than others, and this is just a basket of 30 stocks. I since consolidated it down into 30, where I was starting with 50 stocks a while back. So anyways, here are the changes for this month. We added AMC Networks Inc. We would have added Alt Global Holdings Inc., but this was actually not available on M1 Finance, which is the brokerage I'm using, since it allows you to easily tailor the portfolio towards equal holdings or whatever ratio of holdings you want to have. So it makes managing this portfolio a little bit easier. Since I do want this to be easy, the whole appeal of the Magic Formula strategy is that it's a semi-passive way to invest like a value investor. That's kind of the goal with it. Again, putting that to the test. We removed Altria Group, we removed City Trends, we added Heidrick & Struggles, which I think was on the list a while back. We would have added Interfor, but that is not on M1. I believe that is a lumber company, so that's, I wonder if that's part of the short-term nature of how the Magic Formula screener works, and that it looks at the recent return on invested capital. And I'm sure if you're a lumber producer right now, your return on invested capital probably looks phenomenal compared to previous years, which is probably a short-term thing, one would think, but we'll see what happens there. But anyways, that's just something I thought I'd point out. I did not add that one because I can't on M1. We also added Life Vantage Corp. We removed Minerva Neurosciences, one of the many pharma stocks on this list. We removed Natural Health Trends. We removed Nautilus. We removed Quest Diagnostics. We added Scorpio Bulkers. We added Sturm Ruger, which was on the list a little while ago, fell off, and now is back on. We removed Tupperware. We removed Turtle Beach, one of my favorite holdings in my portfolio outside of this Magic Formula screener. and then also added Unisys. Otherwise, the rest of the portfolio is the same. That is quite a bit of churn, I have to say, for the now consolidated portfolio of 30 holdings. We can see the performance here. Really not much has happened in the about, what are we on, 6 months now or so, or approaching 6 months in using the Magic Formula screener to try and build a portfolio. Now, I've gotten some criticism, rightfully so, I'd say, that I'm churning the portfolio too much since I'm actually rebalancing every single month. You can go here to see all the holdings. You can copy this portfolio if you want to by going to the Magic Formula Investing Screener if you so desire. And you can open up a free account on M1 Finance as well if you want to do that. That I would get a small commission if you use my affiliate link in the description below and fund your account. And I'd very much appreciate that. And it is a free brokerage, so you might as well check it out since I think it has some pretty nice things going for it. But that's kind of beside the point. The point is I'm doing monthly rebalancing, which is something I'm considering changing for the long term. And this is with a couple things that I'm considering about changing in this portfolio as I add more money to it. We're at $3,000 right now in the contributions, or approximately that much. So I'm trying to figure out how I want to address this for the long term, since I don't think doing monthly rebalancing is something I really want to do anyways, partly because it's kind of cumbersome. And it doesn't always make sense, especially if it seems like you just bought into a stock pretty cheaply, and if it seems like it's a good hold for the long term, wouldn't you want to hold it even if it goes up in price a little bit? Just because there's one that might be relatively cheaper, I'd be buying into that one instead and losing out on potential gains for that higher quality company. That's just one thing that could happen. You could make an argument on the other side, of course, but I think for the long term, what I'm thinking about doing, maybe once I get up to, say, $6,000, which would be 1 full year of contributions into this account, and that would also be another full year of data based on my monthly rebalancing strategy. See what would have happened if I would have held all of the things that were actually made this list, if I held them for a year rather than cycling them out like I have been. How different would the performance would have been? Did I outperform or underperform? If I underperformed, I think I'd be very quick to change it to a longer term hold, maybe a 1+ year hold, maybe even a 5-year hold or something more extreme like that, just to kind of see whether these picks that the Magic Formula screener is doing at any given time, see if they're worth holding for the long term. Because my suspicion is that the returns for the Magic Formula screener are probably consolidated into a few very large outsized returns for a few holdings. It's not as though the entire portfolio would overperform every other stock. At least that would be my guess. I think it's just a few that probably carry the portfolio. I really need to see more detailed data. I'm collecting it as I go, so that's part of the reason I'm doing this. But I have a suspicion that that's what's happening, or that's why Magic Formula data in the previous eras that have been studied, I have a feeling that's why the Magic Formula screener outperformed the greater market. I think it's because there were a small proportion of the screener stocks that outperformed by a substantial margin, and that kind of pulled the weight of the rest of this sort of index, if you want to call it the Magic Formula Portfolio Index. I guess that's really the best way to put it. I have a feeling that's what actually happens. But again, time will tell. So that's one thing I'm considering doing, stopping the monthly rebalancing, which again, I'd probably do once I get about a year's worth of contributions and data to really make that final call. Maybe a little bit quicker than that, we shall see. Eventually, I want to stop adding money to this account and just really see how the performance does without me adding new contributions. Just see what happens and let this portfolio run, essentially. That would be ideal. And then maybe making adjustments every year or so as the original book calls for. But as I've explained before, the reason the book calls for actually making yearly rebalancing rather than monthly is because of taxes. It's capital gains taxes. That was the big concern. At least that's how I read the book. That was the main sort of argument behind rebalancing yearly or quarterly. It really wasn't quarterly, but every quarter you would buy stocks and then hold those stocks for a year and then revisit those stocks a year later to see what happened to them, if they're still in the screener. If they're not, then you sell them. And at that point, you would be in the long-term capital gains tax territory rather than short-term, which is at your marginal income tax rate in the U.S. So that's typically much higher than capital gains. Of course, if we get new legislation, that would change things. But the reason I'm doing monthly balancing is because I'm in an IRA. This is a retirement account, which doesn't have short-term capital gains taxes to worry about. So if I make a sale 1 day later, it's not going to trigger any sort of tax liability within the account. So that's the reason I thought, okay, if I eliminate that tax liability that you would have in the short term and just put it into an IRA, then I probably should just continue to buy the cheapest stocks, cheapest best stocks on the list. As soon as they fall off, that means they are no longer one of the cheapest best stocks, and there are others that are cheaper and better, theoretically. Of course, assuming you believe what the Magic Formula screener is telling you, then that was kind of my thinking there. The reason I'm actually doing the monthly recycling rather than yearly, at least yet. But again, I might be missing out on those massive oversized returns that I have a feeling are actually carrying the portfolio, at least in past decades where we've seen more extensive data. I definitely want to get your guys' thoughts in the comments below. If you guys are doing anything with the Magic Formula, if you've adjusted it in a particular way, definitely let me know. If you're going ahead and rebalancing more often than yearly, definitely let me know what you're doing there. Or if you're not even rebalancing yearly, you're just holding for many years. How many years have you been doing this, and what sort of results have you been seeing? Definitely want to get as much data here as possible. I know there are some other channels that are doing a sort of Magic Formula screener series where they run some sort of version of the Magic Formula. We've had Brad Kellner on the channel, and he does his own very modified version of the Magic Formula, which I think is a really good series. He has very specific criteria that he goes through to, again, make it pretty mechanical, but in what seems like a very sensible way, at least based on his investment preferences. He has more criteria added onto the Magic Formula rather than just the simple two factors that the Magic Formula looks at. Now, that's not something I would look to do myself. I would probably look to do different things with the hold times or different things with how I actually rebalance it. And rather than just trying to hand select the actual stocks within the portfolio, at least within this Magic Formula, I would be happy to hand pick stocks outside of this portfolio to see how they do. Again, I'm just trying to test the waters here. If it turns out that the Magic Formula is continuing to outperform everything over the long term, then sure, I'll probably put a lot more money towards it. But I want to test it for myself first, since you never know what will actually happen in the future, and getting more recent data probably would be a bit more helpful than only relying on data from the early 2000s or something like that. Because so far the results have been pretty lackluster. I wasn't expecting massive results immediately, but we're down 3% on the portfolio, which isn't very fun. I would have liked to see some sort of positive return, since I believe the market has been pretty positive over that same time period, starting back on March 26th is when we opened this portfolio. And if we go to today, we've pretty much lost $50, or at least on paper, we've lost $50. So I guess some of these gains are technically realized since I've made the sales, but it really wouldn't do anything to taxes since it's within an IRA. So realized or unrealized, it's all invested into the actual Magic Formula portfolio right now. Again, if you want to see that, I have the screener tracker sheet in the description below. We'll take a quick look at kind of where it's allocated right now. Still 30% pharmaceutical stocks. If there was going to be another adjustment I'd make, I'd consider removing all of those. But then again, I don't know, maybe some of the outsized performances come from pharma stocks that maybe have a drug hit or something like that, or a vaccine. That might be one of the stocks that actually carries the portfolio if I were to hold things for the longer term rather than cycling them out so frequently. I'm just kind of spitballing ideas here. I just want to give you a clear idea of what I'm thinking about with this portfolio. I want to keep it pretty passive, but if there's a more optimal way to make adjustments to the portfolio, I definitely want to do that, especially if it wouldn't be too cumbersome to actually do, to have a sort of semi-passive way to invest like a good value investor, not just one who wants to be a value investor but otherwise is not a good one. Ideally, it could be another useful tool in the toolbox when it comes to investing, but in any event, the Magic Formula Screener is a great place for potential stock ideas. Not that every stock on the list is a great idea. I'm sure many end up not working out very well, but you can say that about many stocks in the stock market. I'm pretty sure most will not do great. It's those few outsized winners that really carry a portfolio, even when we're talking about a broad index. After all, the S&P 500 has a massive portion of its market cap in the top 5 or 10 stocks, and that's out of hundreds. So even with the broadest of indexes or indices, you're getting the same sort of result where you have a few really pull the weight of the actual total index. And I'm sure something similar will probably happen with the Magic Formula, but this is a pretty small group of stocks as is. We're looking at 30 stocks. I don't know how outsized the returns would get within this group, as it's not a super diversified portfolio, but then again, 30 stocks is a decent amount at the same time. So I'm not saying like this is 5 stocks and if you have one outsized return, of course it's going to pull the value of the portfolio, but 30 is now not the thousands that you'll get in a huge index, but it is a decent amount of diversification relative to many of the more concentrated value portfolios that you see out there. In any event, I'll be sure to continue to update you guys on this portfolio on the 28th of every single month. If you want to check out the Magic Formula stuff that I have in the description, go ahead and do that. Or this brokerage, M1 Finance, it is free to use. It is a brokerage I like very much. It has a great interface. It is only available in the US as far as I know. So if you're not in the US, then unfortunately you can't use it, but oh well, you could still get some value hopefully out of this series and in learning about the Magic Formula portfolio and seeing how it actually is doing in real time. I think it's always important to look for new ideas in investing, especially if you're trying to go for a quote-unquote more contrarian strategy like value investing, which is inherently sort of a contrarian strategy relative to the rest of the market. So always trying to keep an open mind, see which strategies might bear some fruit or could otherwise come up with a good concept that you might be able to apply to your own investing. Always good to have that open perspective, that open mind. But otherwise, if you like this video, please like it since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.